Today we're going to talk about something very interesting. It's called internal controls and SOX compliance. And these are two things that come together which allow the building of the foundation for financial integrity. We'll explore internal controls and the regulatory framework, which is often called the SOX, as you probably know, Sarbanes-Oxley. That's what it stands for. And this may not be a glamorous topic in corporate finance, but I would argue that it's a very important topic. Internal controls, they are the safeguards that ensure your financial reports are accurate and your assets are protected and your organization that operate with integrity. And when controls they fail, the consequences can be jarring, it can be devastating. Not just regulatory penalties, but shattered credibility, lost investor confidence, and sometimes the destruction of entire companies. So let me begin with some context. The SOX, or the Sarbanes-Oxley Act, was enacted in 2002 in response to a series of spectacular corporate frauds, Enron, WorldCom, Tyco, and so many others. And these scandals, they revealed that companies had manipulated their financial statements for years, while auditors, boards, and regulators, they failed to detect the fraud or contributed to it. Billions of dollars of investor wealth just evaporated in a heartbeat. Thousands of employees lost their jobs and retirement savings. Public trust in corporate America was deeply damaged. And so the Sarbanes-Oxley was Congress's response. It was Congress's response imposing new requirements on public companies and their execs. And the law, it covers many different areas: auditor independence, corporate governance, executive certification of financial statements. But for our purposes, the most significant provision, it relates to internal controls over the financial reporting. And so there's an entire section called Section 404 of the Act, which requires management to assess and report on the effectiveness of internal controls over the financial reporting process. And for larger companies, it also requires the external auditor to attest to management's assessment, which means that your company must not only have effective controls, but must be able to demonstrate their effectiveness to auditors and their regulators. So before I dive deeper into the SOX requirements, let me step back a little bit and discuss what internal controls actually are and why they matter beyond regulatory compliance. Internal controls are the policies, the procedures, and activities that provide reasonable assurance that the organizational objectives are achieved. They address three very broad categories of objectives: effectiveness and efficiency of operations. They address the reliability of financial reporting and the compliance with applicable laws and regulations. So think of internal controls as the immune system of your organization. A healthy immune system, it does not guarantee that you will never get sick, but it dramatically reduces the likelihood of severity of illness. Similarly, if you have effective internal controls, they don't guarantee you will never experience fraud or error, but they make such incidents far less likely and help detect them quickly when they do occur. And the most widely used framework for internal controls is the COSO framework. And that has been developed by the Committee of Sponsoring Organizations. And this framework, it identifies 5 interrelated components of internal control, and that must work together for the system to be effective. So the first component of the 5 components, the first component is a control environment, which is the foundation on which everything else rests. And the control environment encompasses the organization culture, the values, the ethical tone. It includes the board's oversight role, management's philosophy and operating style, the organizational structure, the assignment of authority and responsibility, and the human resource policies. An organization where leadership demonstrates commitment to integrity and ethical behavior, it creates an environment where controls are taken seriously. On the other hand, an organization where leaders cut corners or tolerate misconduct, it undermines every other control, no matter how well designed. The second component is risk assessment. Organizations must identify and analyze the risks that threaten achievement of their objectives. What could go wrong? Where are the vulnerabilities? How likely are various adverse events? And how severe would their impact be? Risk assessment is not a one-time exercise, but an ongoing process. Because risks evolve as a business changes. New products launch, new markets open, and the external environment shifts. The third component is control activities, the specific policies and procedures that address identified risks. And these include approvals, authorizations, verifications, reconciliations, segregation of duties, and physical safeguards. These are control activities that operate at all levels of the organization and across all functions. And they are the tangible manifestation. They are the tangible manifestation of the control system, the actual checks and balances that prevent or detect problems. The fourth component is information. Information and communication. Relevant information must be identified, it must be captured, and it must be communicated in a form and time frame that enables people to carry out their responsibilities. And so this includes both the systems that processes the transaction and generates reports, and the channels through which the information flows within the organization and to external parties. The fifth component is monitoring. Controls must be evaluated over time to ensure that they continue to operate effectively. And what does this mean? This includes ongoing monitoring built into normal operations and separate evaluations such as internal audits. So when the deficiencies are identified, they must be reported and corrected. A control system that is not monitored will inevitably degrade over time as people find workarounds. Circumstances are changing and the vigilance is fading. So let me discuss a practical application of these concepts to financial reporting controls. The objective is to ensure that financial statements, they are accurate, they are complete, and they're prepared in accordance with applicable accounting standards. And this requires controls over the entire financial reporting process, from the initiation of the transactions through their recording, their processing, and ultimate reporting in financial statements. So the segregation of duties is a foundational control concept. No single individual should control all aspects of a transaction. The person who initiates a purchase should not be the same one who approves a payment or reconciles a bank account. So by dividing the responsibilities, what you're doing is you're creating natural checkpoints where one person's work is verified by another. Now with that said, collusion still remains possible, but requiring multiple people to conspire makes fraud much harder to execute and conceal. Then there's your authorization control, and that is to ensure that transactions are approved by appropriate personnel before they're executed. Purchase orders, they require approval above a certain threshold. Journal entries require review by supervisors. Wire transfers, they require dual authorization, and these controls, they prevent unauthorized transactions and create accountability for decisions. Now, reconciliation controls, they verify that records, they are complete and accurate by comparing them against independent sources. Now, bank reconciliations, they compare the cash records to the bank statements. Account receivable reconciliations compare the customer balances to supporting documentation. Intercompany reconciliations, they ensure that the transactions between related entities are recorded consistently. And these comparisons, they all reveal errors and they all reveal discrepancies that require investigation. So access controls are also important. What are they? They limit who can initiate transactions, who can modify the records, who can view sensitive information. And in modern organizations, these are largely implemented through information technology, IDs, passwords, role-based permissions, identity access management, or PAM software. Access should be granted based on responsibilities and reviewed periodically to ensure that it remains appropriate. So now let's talk specifically about SOX, because this is about SOX, right? This entire session. SOX compliance in the process of assessing and reporting on internal controls. Management must identify the significant accounts and processes that could contain material misstatements. Not every account and process requires the same level of control attention. A small expense account that could not reasonably, a small expense account might not contain a material error, does not need the same rigor as a revenue recognition or a large inventory valuation project. And for each significant area, management must identify the relevant controls, Test whether those controls are designed effectively and test whether they are operating effectively. Design effectiveness is very critical. It asks whether the control, if operating as intended, would prevent or detect the material misstatements. Operating effectiveness, it asks the question whether the control actually operated as designed throughout the period. Then there's testing. Testing involves examining the evidence and that the controls are operating. For an approval control, you might examine a sample of transactions to verify that the proper approvals, were obtained. For a reconciliation control, you might examine the reconciliation documents to verify they were prepared timely and reviewed appropriately. Now, for an automated control, you might verify what? You might verify that the system configuration, it enforces a control and that access is appropriately restricted. And when testing reveals that a control is not operating effectively, you have identified a deficiency. Deficiencies are evaluated based on the severity. A control deficiency, it exists when the design or operation of a control does not allow the management or the employees to prevent or detect misstatements on a timely basis. Now, significant deficiency is a deficiency or combination of deficiencies that are important enough to merit attention by those responsible for oversight. A material weakness is a deficiency or combination of deficiencies such that there is a reasonable possibility that a material misstatement would not be prevented or detected on a timely basis. Material weakness must be disclosed publicly, and they require management to conclude that internal controls are not effective. And this is serious. It signals to investors and regulators that your financial reporting cannot be fully trusted. Companies with material weaknesses, they often face stock price declines. They often face increased audit fees and regulatory scrutiny, and also reputational damage. And when material weaknesses are identified, remediation becomes very urgent. Remediation involves designing and implementing new or improved controls that address those underlying deficiencies that have been called out. But remediation is not instant. You must demonstrate that the new controls have operated effectively for a sufficient period of time. Typically, it runs for 1 quarter, maybe 2 quarters, before you can conclude that they are effective. This means that the material weakness often persists across multiple reporting periods, even when the remediation efforts are underway. So I want to share some perspective on making internal controls effective in practice. And it should be effective in practice beyond mere compliance. Controls should be embedded in business processes rather than bolted on as afterthoughts. When controls are integral to how work gets done, they are more likely to be followed consistently. When there are additional bureaucratic steps separate from real work, they are inviting circumvention. Automation improves control reliability. Automation controls they operate consistently every time without the fatigue, without the distraction, or there are no judgment errors that affect those manual controls. A system that automatically blocks payments to unapproved vendors is more reliable than one that depends on a human being to check the vendor list. And where possible, build the controls into systems rather than relying on human vigilance. Tone at the top is not just a phrase. It is the most important factor in control effectiveness. And if leadership demonstrates through words, through actions, that integrity and compliance matter, people throughout the organization will take control seriously. If leadership treats controls as obstacles to be minimized or circumvented, that attitude will cascade through the organization. So the CFO's personal commitment to control effectiveness, it sends a very powerful signal. Documentation matters. Documentation matters more than you might think. Well-documented controls are easier to train, easier to test, and easier to improve. And when controls exist only in people's heads, they are vulnerable to turnover, inconsistent execution, and gradual erosion. Take the time to document the key controls, the process flows, and the control objectives, and do so clearly. And finally, view SOX compliance not as a burden but as an opportunity. The discipline of assessing controls, the discipline of identifying weaknesses, and the discipline of implementing improvements, it strengthens the organization. Companies with effective internal controls, they make fewer errors. They detect the problems faster, and they operate a lot more efficiently. The investment in control mechanisms, they pay dividend beyond the regulatory compliance. And the CFO, they bear this significant personal responsibility for internal controls, by the way. You certify in SOX the accuracy of the financial statements. You attest to the control effectiveness, and your signature, it carries legal weight. Take this responsibility seriously, build a control environment worthy of trust, and ensure that your organization can withstand scrutiny. Now, the integrity of a financial reporting, it depends on it. Now, some of the stuff that I spoke about are public company related, and although all of my sessions are geared for Series A to Series D or Series E companies, a lot of the practices in public companies can be ported into the smaller staging companies, Series A to Series E. And those are good habits to have. And as you move up the series, you're particularly Series C, D, and E, you want to have more and more effective controls that mirror what SOX requires, what COSO framework requires. So it is always important, although I'm not going to be talking in any of my sessions largely on public company matters, if I do discuss it, I'm discussing it as a framework that we can port into startup companies or new companies. So I hope this framework helps, and as SOX is a very widely used and it has a lot of teeth, if you will. And if you have any questions or comments, please drop a note. We'll move on to the next. Take care. Bye-bye.